Stop scrolling and listen. In the last 72 hours, the United States quietly triggered what could become the biggest silver supply shock of our lifetime. Not oil, not copper, silver. Very few people have put the pieces together yet. The headlines are about soybeans, steel, and trade tensions. The TV pundits are talking in sound bites about GDP and election polls. Meanwhile, a single clause buried deep in a new tariff order just blew a hole straight through the global silver supply chain. And if you use a phone, drive an EV, own solar panels, invest in tech stocks, or care about the defense of your country, this matters directly to you. Today is Wednesday, January 21st, 2026. On Friday, President Trump signed an executive order that slaps a 25% tariff on all Chinese imports, effective February 15th. That much made the news. What didn't make the news is the technical language that changes everything. The tariff applies to all goods of Chinese origin, no matter where they're sitting in the world right now. That one sentence is about to rewrite the silver market. Let's start with the raw numbers. China produces around 3,600 tons of refined silver per year. That's about 115 million ounces. Roughly 30% of that, about 35 million ounces a year, is exported. Those ounces don't move in a straight line from Shanghai to Los Angeles. They snake through Hong Kong, Singapore, and the London bullion market. They sit in bonded warehouses. They're refined again, blended, and quietly funneled into solar panel factories, EV and battery plants, electronics assembly lines, and bullion dealers who supply coins and bars. A big chunk of that flow ends up in the United States. Now add Trump's new rule. If that silver originated in China, it gets hit with a 25% tax the moment it crosses into the US, even if it's been sitting in Singapore or London for months. That's the grenade in the room. Right now, silver is trading around $91 per ounce. A 25% tariff on Chinese origin silver adds about $22.75 per ounce. So a Chinese ounce, once landed in the US, suddenly costs about $113.75. Meanwhile, COMEX spot in New York is roughly $91. Typical physical premiums in the US are around $8 to $12 per ounce, depending on the product. So industrial buyers and big dealers are paying, in practice, something like $99 or $103 per ounce for non-Chinese metal. Put yourself in the shoes of a procurement manager at, say, Tesla. You need silver for batteries and electronics. You have two options: non-Chinese or US refined silver at roughly $99 and $103 per ounce. Chinese origin silver at roughly $113.75 per ounce once the tariff hits. You're not going to pay an automatic 10-15% penalty just to buy the Chinese metal. So what happens to those 35 million ounces a year that used to flow toward the US? They don't slow down, they stop. That flow becomes uneconomic overnight. Chinese origin silver is priced out of the American market. And that's where the real trouble begins. Because those 35 million ounces are not nice to have. They are load-bearing. They've been the flexible buffer that keeps the system from cracking. Before we dive deeper, if this is making sense so far, hit like and consider subscribing so you don't miss the follow-up videos as this plays out. And drop a comment if you've ever tried to buy physical silver during a shortage. I want to know your experience. Let's zoom out and map the basic silver flows. The US mines about 30 million ounces of silver a year. Mexico mines around 200 million ounces. Peru and Canada add to that pool. China mines 115 million ounces, exports about 35 million, and consumes the rest at home. The Chinese exports have acted as the swing supply, the shock absorber. When a solar manufacturer ramps up production unexpectedly, when the US Mint needs more blanks, when an EV company pulls forward orders, or a big electronics run happens, refiners and wholesalers tap that Chinese origin metal to close the gap. Now that swing supply to the US is gone, here's the math the market is ignoring. 35 million ounces of Chinese silver exports at $91 per ounce is $185 billion in annual metal value. Not all of that disappears forever. Some can be replaced over time by extra imports from Mexico or Peru, reallocation from other buyers, and very gradual mine expansions. Let's be generous and assume 30% of that lost Chinese flow can be replaced within 6 months. That still leaves 70% of 35 million, 24.5 million ounces, missing. At $91 per ounce, that's about $223 billion rounded a bit, and you're still looking at roughly a $2.1 billion supply gap for the US silver chain. And the algorithms that sold silver on the trade war headline aren't pricing this in. They see tariffs and think, demand down, bearish commodity, sell. What they don't see are shipping routes, refining bottlenecks, export rules, and the fact that this tariff doesn't just raise prices, it makes an entire pipeline uneconomic. This isn't a surcharge that gets passed to consumers, it's a shutoff valve. You might be thinking, can't we just get more silver from friendly countries? Not at the scale and speed we need. Mines don't ramp on a conference call. New capacity takes years of permitting, drilling, and capital spending. Many Mexican mines are already close to capacity. Peru has chronic labor and political disruptions. Canadian silver mines tend to be smaller and higher cost. Even if geology wasn't a problem, refining is. The U.S. has limited refining capacity for silver. A lot of ore and semi-processed material is refined abroad, then imported back. Cut off Chinese-linked material, and you expose a second kink in the hose. We simply can flip a switch and refine our way out of this. So the 24.5 million ounce shortfall is real, structural, and immediate. There's only one mechanism that can balance that kind of mismatch: price. The price has to rise high enough to crush some lower priority demand, force substitution where possible, and pull in every spare ounce from the rest of the world. No one knows exactly where that clearing price is, but it's not $91. Stay with me until the end, because I'll walk through how an investor could position around this, from physical metal to mining shares, and the timeline I am watching. In any shortage, not everyone suffers at the same time or in the same way. Some industries have big stockpiles. Some have long-term contracts. Some run lean and just in time. Let's go industry by industry and look at the likely order of pain. First, solar, the first casualty. Globally, the solar industry consumes roughly 140 million ounces of silver per year. In the U.S. alone, solar manufacturing is estimated to use 20 to 25 million ounces annually. Every panel on a rooftop or in a utility-scale farm has silver paste in its conductive lines. There is no cheap, scalable substitute that offers the same conductivity and reliability. Copper and aluminum don't cut it in current designs, and the global solar supply chain runs straight through China. Chinese firms dominate wafer and cell production. A lot of silver-heavy intermediary materials are sourced from Chinese refiners, even for panels assembled in other countries. That means even U.S. solar brands are indirectly dependent on Chinese silver flows. Most manufacturers don't run huge stockpiles. Typically, they keep 2 to 3 months of silver-bearing inputs on hand. Here's how the timeline likely looks. February 15th, the tariff takes effect. Chinese origin silver into the U.S. becomes 25% more expensive. Imports slow, then largely stop. By mid-March, U.S. and global solar producers begin to chew through their inventory. By April, smaller firms scramble, bidding aggressively for any non-Chinese silver they can get. By May, we start seeing line shutdowns and production delays at weaker players. Not because they can't pay, but because they simply can't get the metal. All those government subsidies and climate targets, they don't mean much when the essential raw material is physically unavailable. You can print money. You can't print silver. Next, EVs. Just in time meets no silver. We tend to focus on lithium, nickel, and cobalt in EV batteries. Silver flies under the radar, but it's critical in battery management systems, power electronics, inverters, and high-end wiring and connectors. A typical EV uses somewhere in the range of 25-50 grams of silver. Take Tesla as a simple example. About 1.8 plus million vehicles per year. Assume 35 grams of silver per vehicle, a mid-range estimate. That's 1.8 million times 35 grams, 63 million grams of silver. 63 million grams is roughly 2 million ounces of silver per year for Tesla alone, and they are just one automaker. Now mix in this reality. Most auto and EV manufacturers operate on just-in-time principles. They usually hold 4 to 6 weeks of many components, some critical materials, a bit more, but not 6 months. So as Chinese-linked silver flows shrink, here's what happens. By late March or early April, EV makers start to feel the squeeze. Their suppliers struggle to source silver at old prices. Component makers begin to raise quotes or quietly lengthen lead times. A few weeks later, a gigafactory somewhere hits a hard wall. A single silver-dependent part is missing. You can't build 90% of a car. Either the line runs or it doesn't. A day of downtime at a major EV factory costs millions. You can be sure procurement teams are already on emergency calls, trying to lock in future silver supply at almost any price. Then electronics, the giant with tiny ounces. Here's where most people underestimate the impact. Each gadget uses just a dusting of silver, fractions of a gram in a smartphone, small amounts in laptops, routers, game consoles, and servers. But the volumes are enormous. Take Apple. Over 200 million iPhones sold per year, at just 0.3 grams of silver each. That's 200 million times 0.3 grams, 60 million grams of silver. 60 million grams is roughly 2 million ounces of silver, again, for one product line at one company. The broader electronics sector is estimated to chew through 60 million ounces of silver annually. Margins in consumer electronics are tight. A 25% jump in silver cost might only add $1 or $2 to the cost of an iPhone. Annoying, but survivable. The real threat isn't the extra dollar. It's not being able to get silver at all when Chinese exports dry up and industrial buyers begin hoarding. If Apple, Samsung, Dell, HP, Lenovo, and others can't reliably secure silver in Q2 2026, they can't ship enough product in Q3. That's a CEO-level crisis, not a line item. Then defense, where free markets end. Silver sits deep inside missile guidance systems, radar and avionics, military satellites, sonar for submarines, and high-reliability connectors and switches. Defense contractors care more about availability and performance than about saving $1 per ounce. They have legally binding contracts with the Pentagon. If they miss delivery schedules because they can't source silver, capabilities slip, readiness drops. That becomes a national security issue. That's exactly where the US government stops playing referee and steps onto the field. Using tools like the Defense Production Act, the government can prioritize silver deliveries to defense applications, lean on refiners and miners to allocate metal by decree, and defer or restrict supply to non-critical sectors. In a true crunch, the rough hierarchy looks like this. Defense and weapon systems first. Critical infrastructure, the power grid, medical equipment, communications, second. EVs and key industrial uses after that. Consumer electronics further down. Retail coins and bars for the public last. If you're a retail buyer hoping to pick up a few extra silver eagles in that environment, you end up at the back of the line. And here's the uncomfortable truth. This quiet prioritization has already begun, to some extent. Large industrial users are calling refiners, locking in multi-quarter contracts, and offering premiums for guaranteed delivery in Q2 and Q3 2026. By the time CNBC runs a Silver Shock segment, most of the available metal will already be spoken for. If you're finding this breakdown helpful, subscribe for more deep dives like this before the situation fully hits the mainstream. It's a lot easier to think clearly now than in the middle of a panic. Up to this point, we've mainly talked about the US tariff, but China doesn't just sit still when cornered. Let's look at their position. China is the third largest silver producer in the world. It produces about 115 million ounces annually, around 3,600 tons, roughly 14% of global mine supply. It's also a huge consumer of silver domestically. On paper, it might look like they have limited room to play games. If they stop exporting, don't they just hurt themselves? Not exactly. Remember, only about 35 million ounces get exported. Those 35 million ounces are the marginal or swing supply that keeps the global market balanced. Remove them, and the West goes into obvious shortage while China can prioritize its own factories with internal mine supply and imports. Chinese industries face a strain, but the West faces crisis. That's asymmetric leverage. Look at recent history. In 2023, China imposed export controls on gallium and germanium, both crucial for semiconductors and military tech. They introduced an export license regime that dramatically slowed Western access. Prices spiked. In 2024, they applied similar restrictions to certain forms of graphite, a key battery material. Again, bureaucratic friction used as a weapon. They didn't call these bans. They branded them as resource management and national security measures. Expect a similar approach with silver. Here's how this probably unfolds. On January 16th, Trump announces the 25% tariff, with the Chinese origin anywhere in the world clause. On February 15th, the tariff goes live. Chinese-linked silver into the U.S. becomes uneconomic at current prices. Flows begin dwindling almost immediately. Through late February and March, Western industrial buyers start to panic. Bidding wars begin for non-Chinese silver. By late March or early April, China responds, not with a tweet, but with policy. Something like, to ensure domestic supply security and respond to unjust foreign trade measures, exports of certain silver products will require special licenses. In practice, licenses are slow or rarely granted. Western trading houses find shipments delayed or refused. The entire 35 million ounces of Chinese exports to the world are effectively removed. This doesn't just hurt the US. Europe loses supply. India loses supply. The London bullion market loses a key feedstock. The global shortage that was already forming thanks to solar and EV demand suddenly goes from serious to critical. Many commentators will say, China won't do this. They need the export revenue. Run the numbers. 35 million ounces times $91 is about $3.2 billion per year. China's economy is roughly $18 trillion. That's around 0.02% of GDP. They can easily afford to give up that revenue if it weakens Western industry, complicates U.S. military planning, and increases global dependence on Chinese supply chains in other areas. China is not optimizing for quarterly earnings. They're playing a multi-decade game for strategic advantage. When China tightens silver exports, a couple of things happen very fast. The paper markets, COMEX in New York, LBMA in London, are built on the assumption that silver supply is relatively elastic. Higher prices pull more metal into play. Once exports are constrained by policy, supply becomes inelastic. No matter how high the futures price goes, you can't summon extra Chinese silver. The result is that spot prices gap higher as buyers scramble. Futures markets are stressed as more participants demand physical delivery rather than cash settlement. The divergence between paper and physical silver widens. And in the midst of that chaos, one group quietly emerges as a major beneficiary. Right now, the U.S. produces about 30 million ounces of silver per year, mostly as a byproduct of mining copper, lead, zinc, or gold. Only a handful of companies are primary silver producers, meaning silver is their main revenue driver. For years, many of these miners have struggled with low silver prices, tight capital markets, and regulatory friction. But if silver doesn't just drift to $100 and instead surges to $120, $150, or even beyond, their margins explode. At those prices, existing mines become cash machines. Projects that were marginal at $25, $30 silver suddenly become highly attractive. Domestic production gains political importance. You can easily imagine the U.S. government labeling silver a critical mineral, offering incentives or fast-tracked permitting, and supporting new refining capacity on shore. This is the accidental upside of the tariff. It forces a conversation about reshoring critical metals, and silver is right in that mix. But here's the catch. Even if every project in the U.S. pipeline were greenlit tomorrow, it still takes 3 to 5 years to bring substantial new primary production online. So in the long term, U.S. silver mining could boom. In the short and medium term, you still face a brutal real-time shortage and price spike. Nothing you're about to hear is personal financial advice. Think of this as a detailed thought experiment, a framework for how someone might approach this if they want exposure to silver in this environment. We'll break it into 3 buckets: physical silver, mining stocks, and timeline. Physical silver is the foundation. If someone has no physical silver at all and they understand the risk of a structural shortage, the logical priority is to build a base position. Why the urgency? The tariff hits February 15th. As of now, dealers still have reasonable inventories. Premiums, while elevated, are still within historical panic ranges, not insane. Right now, with spot around $91, you can still find government-minted bullion coins like American Silver Eagles or Canadian Maples in the $99 to $103 range. You can still find larger 100-ounce bars in roughly the $95 $98 range, depending on the dealer. That won't last if industrial buyers step into the retail dealer channels. The U.S. Mint suspends products because it can't get enough blanks, and China announces export controls. In a real scramble, premiums of $20 $40 over spot are not unrealistic. Here are some principles for buying physical. Buy weight, not artwork. Skip collectible and numismatic premiums unless you really know that niche. Avoid novelty rounds with huge markups. Stick to recognizable products. American Silver Eagles, Canadian Maple Leafs, 10-ounce and 100-ounce bars from reputable names like Sunshine Mint, Asahi, or the Royal Canadian Mint. Don't obsess over tiny price dips. The paper price could be pushed down temporarily, say from $91 to $85, while premiums stay firm or rise and dealers quietly run out of stock. If the structural story is right, 35 million ounces disrupted, partial Chinese export bans, industrial panic. Getting perfect entry timing matters far less than actually having ounces. Mining stocks are the leverage. Physical silver is the insurance policy. Mining stocks are the upside. When silver doubles, a well-run primary silver miner can see its profits triple, quadruple, or more, because most of its costs are fixed. But miners also bring operational risk, political risk, and financing risk. So you treat them as speculations, not as your core sleep-at-night reserve. Here's what to look for. First, primary silver producers, firms where silver is the dominant revenue source, not just a minor byproduct. Second, unhedged or lightly hedged production. If a company sold forward a bunch of output at $25 or $30, it won't fully participate in a 100-plus silver environment. Third, safe jurisdictions, mines in countries like the US, Canada, or Australia. Be cautious with 100% exposure to high-risk jurisdictions where governments might impose windfall taxes or resource nationalism if prices explode. Fourth, low all-in sustaining costs, ideally $15, $20 per ounce or lower. That way, every dollar increase in silver mostly flows through to cash flow. Examples of names that often come up in this conversation, not recommendations, just illustrations, include Coeur Mining, Hecla Mining, and Mag Silver. These are among the larger North American listed companies with significant silver exposure. A hypothetical approach many investors consider is something like 70% of their silver allocation in physical metal and 30% spread across carefully chosen miners. The allocation depends entirely on risk tolerance, but the core idea is physical for certainty and optionality, miners for upside and growth. Now the timing, the roadmap ahead. Let's stitch all the pieces into a provisional timeline. February 15th. The 25% tariff on Chinese origin goods takes effect. Chinese-linked silver into the U.S. becomes uneconomic at current prices. Flows begin dwindling almost immediately. Late February to early March, solar, EV, and electronics manufacturers start to notice supply tightness. Some begin pulling forward orders, quietly hoarding more silver than usual. Wholesale premiums creep higher. Delivery times lengthen. By mid-March, retail dealers start reporting low inventory on popular products, delayed shipments, and sudden price jumps on physical, even if COMEX price hasn't moved much. The U.S. Mint could temporarily suspend certain silver coin releases, citing unprecedented demand and supply constraints. Media begins to run soft pieces. Is a silver shortage coming? By late March or early April, China announces some form of export control or enhanced oversight on silver exports. Shipments slow or stall. Western buyers realize Chinese silver is effectively off limits. Price gaps higher. Day-to-day moves of $5, $20 per ounce become possible. Industrial buyers race each other to lock in supply at almost any price. Through April and May, some smaller or weaker solar and electronics manufacturers start cutting production. EV makers reshuffle production schedules and models based on parts availability. Defense contractors lean on the government, which in turn leans on refiners and miners. Priorities shift away from the free market. Under these conditions, triple-digit silver, $120 or $150, even higher spikes, becomes a real possibility, not a fantasy chart someone posts online, not as a smooth lineup, as chaotic vertical surges and brutal pullbacks. If this scenario starts to unfold, it won't be a straight line move. You'll likely see sudden price spikes followed by dramatic smackdowns, scary headlines about speculative bubbles and manipulation, and analysts on TV declaring the top multiple times on the way up. Large players who are short silver or who benefit from a low silver price have every incentive to engineer sharp corrections, negative press, and complex derivative games to shake out weak hands. For anyone holding silver exposure, the mental battle becomes, can you separate daily price noise from underlying structural reality? Can you remember that U.S. refining capacity doesn't magically triple in a quarter? New silver mines don't appear in 6 months, and export controls, once imposed, may last years? Physical silver, in that sense, is simplest. No margin calls, no mark-to-market stress, just ounces. Miners require more discipline. Some investors plan to scale out in stages, taking partial profits as prices and share valuations go vertical. Signs of true mania often include wall-to-wall mainstream coverage, friends and neighbors suddenly wanting to get into silver, and ridiculous price targets with no grounding in supply and demand. Let's pull it all together. A buried clause in a new U.S. tariff effectively prices Chinese-origin silver out of the American market. That cuts off around 35 million ounces per year of what has been critical swing supply. Even with optimistic assumptions about replacement, you're left with about a 24.5 million ounce, roughly $2.1 billion hole in the U.S. silver supply chain. Key industries, solar, EVs, electronics, defense, are highly exposed, many running lean inventories. China has powerful incentives and clear precedent to respond with silver export controls, amplifying the shock globally. In the short and medium term, the only real balancing mechanism is a much higher silver price to ration demand and redirect flows. In the longer term, this crisis could spark a renaissance in domestic silver mining and refining, especially in the U.S. and allied countries. You can ignore this and hope the system finds an elegant workaround, or you can prepare. Consider how physical silver fits into your long-term savings mix. Study the miners that stand to gain most from a repricing of silver. Watch the timeline, especially February 15th, late March, and Q2 2026. If you want a deeper framework for tracking this kind of move before it shows up in price, I put together a short educational guide called the Silver Signal Playbook. It walks through things like changes in exchange inventories, futures curve behavior, delivery stress indicators, and policy moves that typically precede big repricings. You'll find the link in the description. If you've stayed with me all the way to the end, drop a comment that says, staying for the facts, so I know who S really paying attention, and so the algorithm understands people still care about real research, not recycled headlines. The tariff is live, the clock is ticking, and the silver market is about to be tested in a way we've never seen in modern history. Subscribe if you want to follow this story as it unfolds, before everyone else wakes up to it.